concentration. So I also then move on to buyer concentration. This again is crucial because one of our key findings is that exit outcomes in Africa are as much matching problems as they are market clearing problems. That essentially means that, yes, part of the work is building a great company, but part of achieving an exit is also essentially matching it to a suitable buyer. And one of the key reasons for that is that the buyer base is very narrow, right? And there are different ways of looking at this. One is by looking at the role of financial buyers versus the strategic buyers and seeing that the latter dominates. But another interesting one is looking at the location of buyers. Here, the story is actually very interesting because what has happened essentially is there's been a shift in the last 10 years from a specific type of concentration to another type. So to put simply, pre-2020, buyers were concentrated in international markets. What has happened is that there has been a rebalancing to domestic buyers, but that has been substitutionary. So whilst we are at a stage where we want there to be a broad-based increase in all buyers and all routes, what has happened essentially, as Dotun said, is whilst international buyers are not as active, that gap has been filled by domestic players. That is a positive, but ultimately what is more important is, again, a broad-based increase in buyer activity. So that's just a bit of a summary of the discussion on concentration. Now, so far, I have basically described liquidity in the VC space in Africa. Let's then go on to evaluate it a bit. And what we did here on this slide is essentially literally plots what we call the capital recycling ratio, which is a very crude measure of just the number of investments in a year, the number of exits in a year divided by the number of investments in a year. Now, ideally, what we would be using here is a proper exit ratio. But the reality of the market today is that the data infrastructure doesn't support that kind of analysis. And this is probably the first time of many times that we'll hear about how data infrastructure itself constrains the picture we can build of exits, and therefore constrains how efficiently anybody can plan for exits in the future. So this is what we use as a proxy. First thing that I'll note about this ratio is I wouldn't be too focused on the absolute value of the ratio. It does matter. Generally, we would want there to be a decent number of exits per year, given the number of investments. That is definitely the case. But as you can imagine, there are many reasons why this ratio could change mechanically. For example, the eagle-eyed amongst you might have noticed that most, or if not all regions, saw a dip somewhere around 2018-19. That dip was an artifact of lots of capital flowing into VC in that time. So the denominator ballooned and mechanically the CRR dropped. It didn't reflect anything different about exits. And as you can see, in healthier markets, things began to catch up and the ratio bounced back. So if the focus isn't really about the absolute number, it's more about the volatility, right? And this is where I will just summarize, right, across the regions. Starting from the US, what stands out there, particularly when you look at the y-axis is how unvolatile that market is. Yes, there are dips and there are highs, but generally, this is a market where exits and investments scale together and will continue to scale together. That is a mature market that has stable recycling ratios. You look at Southeast Asia and what the increasing ratio is hiding is a very important reality. In Southeast Asia, investments and exits have generally increased over time. So although the ratio isn't growing as fast as Africa or LATAM, it's growing in a more sustainable way. It's not a mechanical effect, it is structural. And this is tied to the emergence of new pathways in Asia. Contrast that to LATAM, where the jump in the ratio is more tied to a collapse in investments, right? And then in Africa, what we've seen is there are early signs of moving to genuine capital recycling. This essentially means that exits are durable, but given that investment itself dipped from 2022 onwards, we would expect exits to have increased more sustainably, a bit more like LATAM than it does seem today. So the story here is a mature market looks like stable CRR. A growing and maturing market looks like stable but upward CRR, and it's not yet emerging as clearly in Africa. So the final thing that I'll just flag very quickly to leave us on a positive note is there are signs of emerging pathways, and just flagging two of them. The first is secondaries. So secondaries accounted for somewhere around 30% of VC exits in Africa in 2025, and that's the highest it's ever been. This is in line with global trends as well, but it's a positive sign, not because we love secondaries, but because we're interested in diverse exit pathways. The other thing is endogenous liquidity. This basically is startups buying startups. Again, we don't have a fetish for that. The reason it's important is because it points towards capital recycling being self-sustaining. We no longer need to rely on external investors coming in to buy because the ecosystem itself, the companies being built, can in some cases act as acquirers. Right now, though, this is still early stage and concentrated in specific areas, especially fintech in West Africa. So I'm just going to close off and hand over to Dotun, setting up the conversation on the panel, right? For VCs, for us, the key takeaway is exit planning starts from day one. It's not a natural outcome. And particularly in a market with constrained buyers, buyer readiness is as important as company readiness. So to put it simply, as we build out great companies, we want to build out a pipeline of viable buyers as well. For the ecosystem, data is super important, and VC is performing particularly poorly on that. So when you look at the broader PE space, data disclosure is somewhere around 28% for disclosing values, which is more than double for VC. Just to close on this point and to rally the ecosystem on this, the reason it's so important is it's not just that we are blind to what has happened, but it is that it constrains our ability to leverage data and reality to then make decisions about how to negotiate good exit outcomes. So I'll close there. Thank you very much. And just hand over back to Dotun to carry on the conversation.
Thanks a lot, Michael, I know you struggle a lot to be able to condense more than 6 months of work or 12 years of data into a very short presentation. We're going to just dive into the conversation with the rest of the panel. My first question would have been to you, Michael, but I want to give you some time to drink some water, and I'm just going to go all the way to Ido. And I was joking with Ido just before we went live that he's now writing a lot of papers and white papers and going into deep diving into so many thoughts that some of us are thinking about. Um, Ido, and many of you may have read what Ido wrote last year, a very good essay on the continent on VC, and I think he wrote about two after that series, and the argument that Ido was making was Africa VC is not broken; it's just a bit early. So Ido, you've seen the data, you've seen this data, or some of the conversation we're having now with Michael. Does it vindicate your thesis, challenge it, or contradict it?
Um, I think simply put, I think, I see alignment between the data and what I've been observing. And I think there's a great amount of work being put into this report and kudos to all of you guys who put it together. But at the end of the day, it signals something that is somewhat aligned with the observation that we are not yet seeing liquidity in the amounts that we have hoped to see. I think what it does raise is a question of whether this is just a timing issue, so we should just wait longer, or is it something that is a bit more structural and we have some more fundamental issues that we may want to think through jointly as an ecosystem, and that is touching on the routes to exits, type of exits, potential buyers. I think there's an interesting observation that we are seeing much less international buyers and much more local buyers. There could be an array of reasons to it. Happy to, there's something I've tried to reflect on recently on the concentration in different markets and power dynamics in different markets. Happy to delve into that, but I think that affects the buyer universe as well, the way we are building and forming companies. So the short answer is I see a lot of overlap between the two, in the sense that there's still not enough to look at to sort of say this is exactly where we are in the curve. With that, it's a good sign that things are increasing with time.
Yeah, thanks for that. There is a follow-on question to that, but I'm just going to throw it a little bit to Google. Who is the active practitioner in this mix? You have an interesting job, which is to facilitate M&A with startups, which is like pulling a teeth out of someone's mouth. It's a difficult thing. When you look at this report's finding that acquisition now account for 73% of exits, and a lot of us model on big IPO or big acquisitions. Does that match what you are experiencing on the ground? And more importantly, by the way, what's the quality of this 73% if it matches what you are seeing on the ground?
Thank you very much, Dotun. First of all, just to give some context, my role does go beyond just M&A. It's exit of all forms. Maybe one day I'll be helping our portcos do an IPO, but also there's a lot in secondaries as well, I think, as the report has pointed out. So to your exact question, the 73%, it does align with what we've seen, which, as you said, Michael, is not a surprise. In developed markets, you expect that in the most developed, the US, roughly 50% of exits for venture-backed businesses and also in PE come from trade sales, M&A activity. And then there you have an equal split between secondaries and IPO because it's a more developed market. But as markets get more developed, you see that trade sale number come down. But in less developed markets, majority is through acquisitions. So it aligns with what we're seeing. The difference, however, here is, well, I guess the difference is on two vectors. First, your point around international versus local acquirers. And then the second point around cash sales versus share swaps. If I deal with the first on international versus local, again, you done. I like you don't want to applaud the work you've done because it's really hard to get hold of this data. So just going with what was publicly available and like listing out deals that everybody knows about feels like, at least from the 2020s and the ZERP era, felt like the heyday of Africa VC, and we saw a lot in acquisitions and therefore exits. There was the Paystack acquisition, the Sandwave acquisition, Biotech and InstaDeep, Expensia, Payspace, and these were all international acquirers putting down big checks to acquire African businesses. In 2024, though, we had a big deal, but because it was alongside the others, I think it got drowned out with Adumo being acquired by Lesaka Technologies. I think that's important because it was a local acquisition, but because it was alongside a long list of foreign, people didn't notice. And it was above the $100 million mark. It was at $85 million. Since that point, we're beginning to see a bit of a trend. Can't call 1 year trend. Let's see what happens next year. And I want to put that big caveat because as IPO markets open up in the West, we'll see more liquidity being created for companies to come and invest. Open question as to whether they'd want to invest in market access to Africa, because it's just less valuable at the moment versus other parts of Europe or Latin America, but at least there'll be liquidity post IPOs. But what we've seen in 2025, following that Adumo and Lesaka acquisition, and many more acquisitions that look like that, particularly in South Africa. So last year, we saw a consolidation between licenses and innovation in the fintech space, and it drove a lot of acquisitions. The largest of these was yet another acquisition that was below the $100 million mark, when Nedbank acquired Ikoka for roughly $95 million. And then we saw Bank Zero acquiring the acquisition between, Lesaka acquiring Bank Zero, which is the fintech acquiring a startup. And then WalletDoc and Capitec, Cloud Badger and Pepcore. So there's a lot of consolidation in this space in South Africa, but 100 million being the top figure and looking like the top end of the market. South Africa, you might say, is more liquid. There's a lot of this that goes on. But what's interesting is it wasn't only in South Africa, it also happened in Kenya. And in Kenya, we saw a bank there make acquisitions of fintechs. So KCB acquired 2 assets. They acquired Pesapal and Riverbank. And it's only a year, but as foreign capital goes out, we expect to see a lot more of these kind of deals happen in the market, particularly in the fintech space, as there continues to be a need for consolidation between innovation and licenses. So fintechs can no longer operate without a license. So need to be joined with a bank somehow. And as banks continue to have to face off mounting pressure from fintechs, they've realized it looks like there's been an appreciation that it's hard to build internally and it makes sense to acquire this innovation. So that's where we are. That being said, I mean, last year wasn't a complete wash for foreign acquisitions. We did have a foreign acquisition. Motorola acquired Rapid Deploy, a South African company, for 241 million. But again, that was one foreign, not at the 500 million level, not even up to the 250, but more local below the 100, and actually far more activity, according to what I've seen, below the $20 million mark. Now, on the second question, with scale-ups, acquiring startups, I think it's a good thing. And I think the reason why it's happened is because there's been less funding. I mean, we've grown in funding on the continent, but a lot of that has been venture debt. And so compared to the ZERP era, when a lot of these businesses raise rounds, there's just less funding available. And it's impossible to continue to survive as a subscale business because then you're not able to raise funds. So it makes sense to be consolidated into larger businesses who can then support with things you can't get access to, like working capital finance or access to quality talent or sometimes access to a license. And so I expect to see more and more consolidation. I expect scale-ups to look for access to licenses, for example, via these smaller businesses, or acqui-hires via these smaller businesses. But now the quality of exit, your question, share swap versus cash. What we're seeing in the first bit is where an incumbent, a large bank or telco makes an acquisition, they don't want to pay with share swap, they pay with cash, because actually it's a small portion of their value. And so it makes sense to do a cash acquisition. With these scale-up acquisitions, their value is still, their valuation has not yet been crystallized. And so there's a reticence to actually acquiring with cash. And these businesses are often not cash rich. And if they are, it makes a lot more sense to deploy that cash into actual operations. And so it's good that this is happening. But from an investor perspective, I think where there's a question mark is an understanding of the valuation of that company that has acquired the scale up, and also getting line of sight to cash liquidity on that stock that you've now gotten in.
Thank you very much, Gugwa, for bringing such a rich and experiential perspective to this conversation about exit. Like I said, exit is almost like a unicorn. Everybody talk about it, but nobody have seen. A lot of people have not seen it in the wild, and I hope that we're going to be seeing more of it soon. So thanks for bringing that perspective. I think there's a question about the capital recycling ratio, which actually funnily, I have a similar question from Michael, who had sat with the data for a long time. So the capital recycling ratio for Africa is 0.03 to 0.06, which is the amount of money coming in versus going out. And what that data shows is that we're having less money coming in the last few years, and that's why that ratio is a bit better compared to Asia, which is about 0.03 to 0.05. So I feel uncomfortable with that number because we're not scaling the way Asia is scaling in terms of capital coming in. Can you, Michael, walk us through why that improvement we're seeing in Africa is not like that of Asia, even though on the surface level the ratio looks good, and what will good look like for a data like this?
Thank you, Dotun, and thank you to whoever asked the question as well. So I'll just touch on Asia very quickly in terms of what we're seeing there. Again, the ratio obscures this, but what's happening in Asia, broadly speaking, over a period of time is investments and exits are scaling together. So investments are going up and exits are going up. For example, this is in contrast to LATAM, where the spike in the capital recycling ratio is mainly because there's quite a steep decline in investments over a couple of years, right? So that pushes up the ratio. But the other thing happening in Southeast Asia is we are seeing more activity along diverse paths, right? And the key emphasis here is more activity, in that there's still a dearth of IPOs and so forth, but they are emerging. These newer paths are emerging in a way that is allowing the markets to create benchmarks, right? And that is super important for thinking about the future. The first 10 VC-backed IPOs are a lot more important than the next 20 in terms of setting, well, particularly within a short space of time. If we have one every 5 years, it doesn't really tell us much, right? So that's what we're beginning to see in Southeast Asia. So it's diversifying, not that deeply, but in a way that is allowing us to build benchmarks for those routes and allow people plan exits along those routes. In Africa, what's happening more is investments have declined at least up until 2026. And exits have, broadly speaking, been either stagnant or just gone up a bit. However, what we would expect to see is if the denominator is declining and the numerator is going up, you would expect to see a much larger change. If that's not happening, is because the exit activity itself isn't ramping up as quickly. The important thing to note as well is I'd mentioned that a better assessment would have been an exit cohort ratio analysis. And the reason that matters is between 2017 and 2023, roughly, Africa built, as Dotun said, hundreds and thousands of startups. So there is a backlog of startups that we don't expect all to exit, of course, but it is different from a situation if that backlog had not been built. So the reason that backlog is important is because it puts more pressure on ensuring that there are viable exit pathways, right? So assessing where we are now today is a lot more important than 5 years ago. And just to close, in terms of what good looks like, for an ecosystem like Africa that is maturing, we want two things. One, a steady increase in the recycling ratio to show that actually that backlog is being dealt with and we aren't forming bottlenecks. And secondly, relative stability in the ratio. We don't want a situation where a comment from President Trump takes the ratio from 0.15 today to 0.07 tomorrow, right? Again, that points to instability in how liquidity forms in the ecosystem. So I'll just stop there. Thanks, Dotun.
Thanks. Very good. I think one of the key point there is about the timeline that we're hearing, as well as some of the factors that can affect the ratio. But also, the more importantly is that we need money coming in and money going out to be scaling at the same time. Ido, I'm going to throw the ball back to you, and I mean, for your sayings, I'm still going to quote one of your papers. I think it's the one Act 1 where you argue that we need stepping stone exit in tens of millions before expecting billions of dollar outcome, which I fundamentally agree with. Although the scale might be a bit different. But here's the question. There are fund managers out there who fund one vintages is now in their 8, 9 years or 10 years old, right? And the LPs are not asking for tens of millions of exit because it will bring everybody almost to zero. They're not patient anymore. So they're asking for distributions. So how do you reconcile that honest long-term story and measured exit to the short-term reality that the funds have to face now, who are running out of time?
Let me try and do two things. One is I want to quickly touch on a point that was raised, and I think is an important distinction, and then touch on your point. I think the two tie. We have touched a few times on this ratio of capital recycling and so on, and I think what we are measuring currently, because we have, the type of data we have is mostly how much companies on a numeric company number, and not on a cash on cash return number. And on cash, if we look at what we have, and this is guesstimating because my data is not necessarily better than anyone's, but we're on a good day somewhere around 0.1% vis-a-vis mature ecosystem. It will be between 0.5 and 1.5. And I think this is where the big gap lies, because it's not the number of exits, it ties to the quality, quote unquote, of exits. And when we look at our secondary, for instance, growth in transactions, which is fantastic on one hand, but A is still subpar with the rest of the world, which sits at around 30. But more importantly, most of our secondary transactions happen on seed A and B. On seed A and B, on average, you would do a secondary of 10 to 20% on a good day of the transaction size. If you look at the actual sizes of the transactions that we're quoting as the largest secondary transactions, we're talking about tens of millions overall over the last 5 to 7 years. 100, 150 if we're very, very generous. This is, compared to, I think, roughly about 1.5 billion in LATAM in the same period, India, higher numbers, and so on. So that is to say, not all exits are equal, and I think we've touched on that, and drives a point to LPs and pressure on funds. One thing is to want to see DPI at all costs, but it's also the quality of the DPI. And I'd argue that not all DPIs are born equal. In other words, if you know that you have an asset that needs more time, the conversation that we should, as an ecosystem, be able to have with the LPs is also what's the actual quality of the asset and the actual quality of exiting it now versus later. Because if we press too many early exits, we will remain in this bucket of an ecosystem that only returns 10, 15, 20% of the capital invested. And over a period of time, this will not bring on new LPs because they will look at the number and say, the math doesn't square. So there is an interesting tension here and a conversation that we should try and push with LPs, which is not just the numeric DPI at a point in time, but also what is the quality of the underlying assets, which is, of course, a harder measure. And how do we, marry the two and not sort of shoot ourselves in the foot by producing numerically a lot of exits very early at low figures that don't necessarily contribute to the how global capital is looking at the ecosystem in terms of putting in more money. That was a very long answer to a short question.
No, that's good. That we're dealing with data here, so it's good to give that context. I'm conscious of time, but I have one cheeky question for Google, but I'm going to ask the most important one first, and then I can ask the cheeky question, which is about M&A infrastructure or exit infrastructure. One of the key points that the data didn't really, or the research didn't go into is the infrastructure around M&A. Remember, many years ago when my partner and Kola initially started our fundraise journey, and we went, that was the 2017 or 18, we went to the state and we met and Horowitz. We went to his and we met Ben Horowitz, and he said something about, hey, Africa is not as sophisticated yet for the infrastructure that they have, which is there's a lot of trade sales, IPO, and stuff. So we might need to start building things from the ground up as we are raising money. And one of the key things that I observed that there are sophistication around lawyers, bankers, advisors who know how to price and close Africa to Africa deals or this. I don't think we have that. The capability is very thin if you do. So how much of that, Ogugwa, of the exit problem we have now is a deal infrastructure problem? And what will it take for us to build that out?
I don't think it's a deal infrastructure problem. I feel like every day I meet tall new bankers. People know what they're doing. And M&A activity happens all the time in PE, and it's actually very, very well done, very rigorously priced. I think the issue, which perhaps is an ecosystem infrastructure problem, but less a banker problem, is business preparedness. If a lot of these are going to be trade sales, the businesses that are going to be acquired need to be prepared for that event. If you're going to have a trade sale, sometimes you're lucky and the company just finds you, wants to buy you. Usually it's via a process. The process is often a dual track process in line with PE. So you need to be a business that is profitable or has predictable cash generative cycles. We're not pushing a lot of our VC-backed businesses, even if they're 10 years old, to be there. And so they're just not appropriate. If before you have an acquisition, I previously, before this time, was at Vodafone, busy doing that, trying to buy and sell companies. It doesn't happen overnight. It takes a minimum of 3 years to build a relationship, to go from first a commercial partnership, then a strategic partnership, be able to internally synergy map and bring that to bear conversations with trade buyers. We're not proactively doing that with our VC-backed businesses. I think that's a big issue. And also for a lot of businesses, recently we had Sumitomo in Mkopa. They've now ramped up to 20%. That in itself was a gradual process. A lot of strategics want to try before you buy, not only via commercial partnerships, but also cap table participation. And I think that investors are proactively looking to partner with those strategic buyers early on in the cash raising cycle of businesses. So it's less the bankers. I think the bankers are doing a great job, so is the lawyers. It's us within the ecosystem, the VC ecosystem, making sure that these businesses are prepared to be bought when the time comes.
Thanks. And I think there's a big lesson there for a lot of us who are managers or even startups or founders is you need to be ready for the market. The infrastructure is there to be used, but it seems that there's a mismatch between the readiness of the ecosystem to the market. Here's my cheeky question to you. So if a startup A is buying startup B and it's all stock to stock deal, and you're selling startup A to startup B or startup B to startup A, do you call that exit when the startup B it's not, you don't know whether there's liquidity there? Would you call that do you count that as exit?
So my KPI is actually DPI, not exits. So in
Okay.
line with, for me personally, has an exit occurred for whoever's an investor in startup A that got acquired? Perhaps an exit has occurred from their stake in that business. But for us, apartheid, we don't have the opportunity to provide DPI to our LPs, and that's all they're asking me about. They're asking me about cool exit stories. And so when that sort of transaction happens, like I said earlier, we still need a clear line of sight to cash conversion on those shares, probably through a secondary market, and much better if it's something that can be controlled by the acquiring business.
Good. So it's about the DPI, not just exit, because exit can be the business folding up and everybody's leaving. So that's exit as well.
Yeah, I guess just to give context, we all, unfortunately, in this ecosystem share very similar LP base, and they need cash out that they can recycle back
Yeah.
into the ecosystem. They
Yeah.
can't recycle anybody's shares back in nobody. I mean, if you were fundraising and somebody said, hey, take half a billion of whoever's shares, even if it's Anthropic shares, you still need cash. And that's the issue. We need to produce cash.
All right. I know we're running out of time, but I have one final closing question for all of you, the three panelists, and I want to give. I know some of you are throwing your question on the chat. If I have the time, we might be able to look at it. But before I ask my question, please download the report if you have not done so, and also register for the index as well, so that you can track what is happening in real time in terms of exit. And if you're a fund manager here, we need you to participate in the index. So I want to end with a practical challenge for all our panelists. And if each of you had to name one concrete action, one thing that either a fund manager, founders, or policymakers or LP could do in the next 12 months that will mostly move the needle on the quality of exit or improvement in what we're talking about that. Now, what would that be? I'll start with you, Michael.
Yeah, thanks. I think I hinted at this already, but it would definitely be more data transparency. I think data transparency is important in every facet. It helps with company legibility, even when we spoke about M&A transactions and startups being ready for those kinds of deals. What we see, for example, is that that's more common in the MENA region, partly because of that, right? So it's important for company legibility. It's important for pricing. It's important for benchmarks, and it's just important really for mapping out future exit activity. So for us, it would definitely be data transparency.
So more data transparency. We need to see. We should not be flying blind anymore. So we should be having more data, especially for pricing and also for to get more capital to the ecosystem. Ido.
I think we are in the short to midterm very dependent on local buyers, domestic buyers, and we are still acting as if we're two parallel universes, and that is not serving neither side of this equation. The startup world believes that we invent sliced bread every morning, and fixing all everything else in industry could have never built. And on the flip side of that, they look at a bunch of kids and say, let them toy around and we'll make money in the meantime. So we need to marry these two universes. I think there's a lot of overlap. I think there's a lot of room. We're seeing a lot more of it in South Africa, which is much more mature on this relationship than other parts of the continent. And to me, that needs to be a dedicated effort. By the way, LPs sit as shareholders in many of those entities on both of these universes, and could act as this bridge, but it's in the hands of everyone in our ecosystem to make this effort.
Great. Thanks for that. Ogugwa.
What Ido said, early conversations with potential acquirers, I think that's the single biggest lever in making all of this work.
Yeah, thanks. I think if I may add to that, I've been spending a lot of time modeling our fund, doing the extra modeling, and one of the key realities that is using data to say that most of the exits in Africa is less than $500 million. So I have to model below that significantly, and then that impacts the way I price company or the expectation I'm setting in at when I'm coming in. So it's a DPI driven conversation from the start. When I'm looking at a startup, what is the value here? Not about what that company think they are worth. It's about what can we get out of this, and what is the funding pathway to get there, and what will be my ownership by the time I think realistically they will get to that place I think they will get to, and then what does that mean for my fund? So all of those things are going into the model. And now what that means is that I'll be having difficult and tough conversations with founders at the beginning, because I have to think about the end in sight, about the DPI and the reality of the market I'm in. And so that is one of the things that this data is also showing me, that I need to make change and change expectation for me and the conversation I'm having with my founders. Thank you very much, panelists. This has been great. I think we should continue the conversation by please read the report, challenge us, ask questions, and hopefully next year we're going to have another data as well. I've hand over back to Ade, who is going to close us up.
Okay, thank you so much, Dr. Dotun. Thank you so much, our panelists. We hope that you've had a fantastic session. Please do reach out to us, continue the conversations on LinkedIn, on Twitter. We are very much active across all these channels, and reach out to Michael, reach out to Ido, reach out to Ogugo, reach out to Dotun. I'm sure they'll be happy to answer any further questions that you might have. Lastly, as Dr. Dotun has mentioned, the SVL Index, again, is public and available to all. The link has been posted in the chat. As well, if you would like to read more of Ido's papers, he's also dropped a link for you to be able to access that. Lastly, as well, if you're interested in the data behind this report, I've dropped a link for that. You can access that by requesting a demo to the Stears platform. Thank you once again, and I do hope you have a fantastic weekend. Thank you, everyone.
Thanks.
Thank you.
Thank you.